Hello and good afternoon.
Good afternoon, Funke.
Good afternoon. So today, Financial Recovery Consultancy will be talking to us about how to pick and analyze stocks to invest in. As we know, investments are the new way to go in Nigeria and globally. With the rise of Bitcoins, Forex, and the likes, it is best that we all have financial literacy and financial information on where to put our money. This is to ensure that we make a profit and things get better for us. In the recent times, investing in different things like agriculture and the likes have had its pros and cons. So the best for us to do now is for us to be able to very well analyze and pick stocks to invest in. To help us get this knowledge today, we have Mustafa Mohamed, who is the head consultant for Financial Recovery Consultant. He has 7 to 10 years experience in accounting and finance. He has worked in organizations like Banana Island Schools, Glazed Dental Clinics, Pivotage Consulting, and a host of others, just to mention a few. So I'll pass on the microphone to my good financial colleague, Mustafa Mohamed. Thank you.
Thank you, Funke, for the humble introduction. Let me also welcome John Oluwafemi and Fatima Adeni to today's webinar. So, like Funke has rightly said, this is the second series in our financial literacy webinar. Before now we had basic knowledge of what you need to know as an investor when it comes to personal finance. So you can go down to our YouTube channel and take a look or listen to what we discuss on that particular topic. But for today, like Funke rightly said, we'll be looking at financial literacy, how to analyze and pick stock to invest. We have realized that so many people have cash and they don't know what to do with it. So we felt, how can we help? How can we be of assistance? How can we educate people, inform people to know where to put their hard-earned money, as well as earn something at the end of the day? It might not be much, but at the same time, it would help you to solve some financial responsibility, take care of some of your financial problems. And that is why we came up with this idea of organizing financial literacy on how to analyze and pick stock to invest. When you invest, your sole aim is to earn an income. You are investing in a passive way. You are not actively being involved in whichever company you've put your money into, but you are passively what participating in the day-to-day activities of the business. So without much ado, let's go on and start with today's webinar. Quotable quotes. According to Warren Buffett, he said, never depend on a single income. Make an investment to create second source. I hope everyone can see my slide. Hello? Hello? Okay. I want to
Yes, we
believe
can.
you can see my slide. So a table of contents. We will be looking at what is investing. Is investing an art or science? Different approaches to analyze stock. When you're analyzing your stock, what do you look at? You analyze the quality of business and management. You analyze the growth. What is growth? Growth and length of growth. Financial statement analysis, which seems to be the most important of what we'll be looking at today. Then we also look at what is valuation. We also look at you as an investor. How is your mood when it comes to investing? You need to reflect on yourself. and also investment checklist. Introduction. Low financial literacy level and poor financial education are the root cause of financial problem faced by many financial literacy matters on many faced by many. Financial literacy matters on many levels. It is not it not only help people manage their financial affairs and improve their standard of living, but also makes an important contribution to the soundness and efficiency of the financial statement and to the performance of the economy in general. Yes, we can't shy away from the truth that our lack of financial literacy is causing a lot of problem to us. Number one, if you don't have money and probably you have health crisis, tell me you won't be able to visit the hospital or get the best doctor to help solve your financial your health issue. Number two, we have so many family who can't afford to pay for their wards school fees to get the necessary education to be able to move ahead in life. So if we are having all these problems that an average family is facing, how do we get to solve them? I promise you, if you are financially literate, you'll be able to solve majority of this problem without having to suffer them. So how do you do this? You can do this by investing in several companies. You can invest in companies that you feel are performing to the best of your knowledge, and then at the end of the day you get some income from them and be able to solve your problems. Also, from financial illiteracy, you'll be able to understand that saving is not the end of whatever you earn. When you save, you can also invest. When you save, you put your money into a particular company. What does that do? It allows the company to be able to add to the growth of the economy. How does that happen? It employs people. It's also pay taxes to government. The government has enough tax to sort out its development responsibilities. So by doing this, it also helps the economy to grow. So this training is an education on how to pick stocks and analyze to invest. Average person just tries to save without thinking of investing such savings in income generating opportunities. Yes, like I said, financial literacy doesn't end in just saving. It doesn't end in just saving on the average 10% of your income at the end of the month. When you save, look for those opportunities that you can put such savings into. And you will agree with me that in today's Nigeria, with the current rate of inflation at 17%, thereabout, you can't save. And then after you save, you want to buy, or you go to the market and then still expect what you've been buying at 10 naira to remain at that amount. No, inflation must or would have eaten into your savings. There's no way about that. There's no two ways about that. So when you save, try as much as you can to go beyond savings, invest such savings. So we said the average person just tries to save without thinking of investing such savings in income generating opportunities. This is because either they don't know how to or what to invest in. Hence the reason for this training. Yes. This training will highlight the most important way to analyze and pick stocks to invest as an investor who is not financially savvy. Yes, for those of us that are not financially savvy, that don't know the technical parts of analyzing stocks to invest in, this training will be able to give us that idea, not necessarily the whole concept. They say too much analysis leads to paralysis. So if you have the basic knowledge, I feel you are good to go. So let's move to the next slide now. What is investing? Investing is an act of putting your funds into a venture business activity with little or no effort to generate income. Yes, like I rightly said, you are investing in a company that you don't have an active participation in. It is more or less, can you hear me? It is more or less a passive venture where you are giving some people your money to help you to generate income. So it is a passive venture now. It is not something you're actively involved in. This can be through stocks. Yes, investing can be through stocks. It can be through bonds. It can be through real estate, etc. Investing requires time and risk taking. It is an effort that is not casted in stone, but with discipline, the expected yield is worth it. Yes, as an investor, you need to have one of those qualities to have as an investor is risk taking and patience. You need to be very, very patient, and at the same time, you need to be risk tolerant. Yes, there are some investors that are risk adverse, and that is why they don't really, really invest in some assets that are risky. But from experience, we realize that those assets that are risky are the assets that tend to give you the highest or the highest returns. So investment requires time and risk taking. Is investing an art or science? Yes. This question comes up most of the time where people ask if investing is an art or science. Investing is an art, at the same time it is science. When investing is done by our intuition, that is what you feel, what your body is telling you, or your brain is telling you to go for. Maybe you feel I feel GTB or Zenith Bank or Dangote will do better in coming years, without even analyzing, without doing any research or something. Then it is intuition. Also, when investing is done based on experience, maybe you've had a couple of experiences investing in a particular sector or in business, then that is also an art. Or it can be judgment, common sense. All these are basically investing in a form of art. But in the case of science now, when you now use both quantitative and qualitative analysis, when we say qualitative, you are looking at the report of the company you are about to invest in, as well as the financial statement of the company. Then now you are investing based on science. So investing can be art or science. When you use your intuition, experience, judgment, common sense, it is art. When you use qualitative analysis and financial or quantitative analysis, then it is a science. So let's look at the approaches to analyze stocks. I would like us to pay attention to this part. When we are analyzing stocks to pick to invest in, we have 5 approaches. Number one approach is the top-down approach. It goes from the top downwards. We try to identify the microeconomic factors. What are the microeconomic factors? We look at inflation, we look at cost of capital, we look at government policies, government regulations, we look at industry standards. Those are macroeconomic factors that we need to consider before we pick that particular stocks to analyze further. Also, we identify good going sectors in the economy. You look at those sectors in the economy that are good, that are thriving, that are doing so well. You identify good companies in this sector. Yes, when you look at the sector, inside the sector, you start looking at the companies inside the sector. Let's say, for instance, we have the telecommunication sector. You've analyzed and see, okay, is a sector that is thriving. you look at those companies within that sector. We have the likes of MTN, Airtel, we have the likes of Glo and Etisalat. So from there, you narrow down the companies you want to invest in by analyzing further. Let's move on to the second approach. We have the bottom-up approach. The bottom-up approach starts with identifying individual companies now, performance matrix. So if you look at it, in the case of a top-down approach, we started with the microeconomic factors. But in the case of bottom-up, you start with the company. So you identify the individual company's performance metrics, e.g., EBITDA, that is earning before interest, tax, depreciation, and amortization. You look at the net income, you look at the revenue, and all other performance metrics. Then you look at the screen stocks valuation and profitability metrics, that is profit after tax, profit before tax, and other profitability metrics. You look at the valuation, what is the value of that company on the stock exchange compared to the book value of the company. Then you also now look at the in-depth analysis, fundamental analysis. You do a fundamental or in-depth fundamental analysis of that company. Let's move on to the third approach. We have the pick what you see. Yes, this sounds very, very easy. Pick what you see. You can, whatever you do daily, from there you can pick a stock or a company and decide to invest in. You can pick, let's say, your breakfast. You start picking from the FMCG, that's the fast moving consumer goods. You can pick the fast foods, the Chicken Republic, the Mr. Biggs, the place and the likes. You can pick hotels, electronics, telecommunication, manufacturing companies, companies that manufacture TV, that manufacture phones, companies that manufacture basically electronics, travel and tourism, airlines, hotels, restaurants, housing, etc., entertainment, movies, music, comedy, sports, etc. So the pick what you see approach has to do with your daily activities or what you see around you. Let's move to the next slide now. We have pick what you do or know. Yes, what you do or know. We do a lot of things and we know to some extent things that go around us. So you can invest in what you know or do. It could be your profession, it could be whatever your family, someone your family member is doing, you invest in it. Insight helps to pick stocks with ease. Yes, in this case, your insight, that's your experience in that particular thing you do, helps you to pick stocks with ease. Then from there, you can decide to analyze further, and it's also easy to analyze. Also, we have the cloning stock ideas, stocks names from big investors or investment firms. Yes, we have so many investors that we listen to. When I started the webinar, I mentioned Warren Buffett. It's someone that we all know in the investment community. So stock names from big investors or investment firms can be cloned. When we say clone now, you can decide to go with whatever they say. From there, you can ignore further analysis based on what they've said. And then there's always confirmation bias and halo effect. That is, this is what Warren Buffett has said. So therefore, I can decide to go with this without doing any further analysis or any research of my own. So all these approaches will help you to pick stock of any company, depending on which one you feel is okay or convenient for you. So let's move to the next slide. Analyzing quality of business and management. So after you must have used those 5 approaches to pick a stock, it is the next thing to do is to analyze the quality of the business or the company you have chosen. So in analyzing the business, it is important to know the quality of the business and management one intends investing into. Yes, it is very, very important as an investor to know the quality of the business and management one intends investing into. So what are those things you need to analyze in terms of knowing the quality of the business and management? Number one, the nature of the business. What does the business do? What is the business into? Is it a merchandising business? Is it a business into telecommunication, providing voice call, data for browsing the internet, transportation, moving people and goods from one place to another? Also, you look at the cost of capital. Yes, at times most of these business don't really have the financial capability to start or run whatever business they are into. So what do? They also source for loans. They source for funds, and most of these funds don't come at no cost. They come with a bit of cost, which we call cost of capital. In a layman's term, is interest. So you also need to know what is the cost of capital of the fund or the loan the company is using to finance its business. You also need to know the growth, the growth of the business. Growth can be in different forms. We will also look at that as we proceed. Also, you also need to look at the competitive advantage. What is the competitive advantage of this company amongst its competitors or its peers? What is that thing that puts the company ahead of its competitors? Also, you also need to look at the pricing power. Does it have the pricing power to sell in the market in which it's operating? Then the last thing, you need to look at the financial numbers. Yes, we can't overemphasize on the importance of the financials. The financial statement of the company is very, very important to analyze before you invest in a business. So let's now look at the quality of business. We have three qualities of a business. We have great, good, and gruesome. Characteristics of a great business is earning higher than cost of capital. Yes, like I earlier mentioned, the cost of capital is the interest the business is paying on the loan it has used in expansion or kind of bettering the or battering the business. So if you are earning higher than the cost of capital, is a great business, because it will be able to meet up with the demand or the demand of the creditors or the lenders now, before it comes to the investor now, in terms of whatever dividend you are getting at the end of the day. Also, stable business, asset light. When we say asset light now, it tends to have less of physical asset and more of intangible asset. No huge capital expenditure. So great businesses tend to have a less physical asset and more of intangible asset. That is capital expenditure, maybe land and building, plants and machinery, motor vehicle, and the likes. High pricing power, yes. If it has high pricing power, it will be able to have more revenue to take care of its overhead at the end of the day, declaring enough profit which can be split into two: dividend for the shareholders as well as income to be retained for future expansion. So if a business has high pricing power, then it is a great business. High and rising return on investment, high free cash flow, and high dividend payouts. Also, high and increasing competitive advantage, brand, low cost of production. Let's move to the next quality of a business: good. So in the case of a good business now, it's in between great and gruesome now. It tends to have a moderate pricing power. It's earn moderate higher than cost of capital. Yes. High competitive advantage primarily from economies of scale. Yes, that is expansion. Let's say economy of scale can be when a company decides to expand beyond its original place, having branches around. It could also be a competitive advantage where maybe your competitors don't have money to expand in such a manner, so you can reach the final consumer more than or before your competitors now. So that is an example of competitive advantage. Is a form of economies of scale. Steady and attractive return on equity. Dividend payout is moderate. That is how well did they pay dividend at the end of the year to their investors now. So the last one is gruesome. The gruesome is a situation whereby the business end lower than the cost of capital. Like I said, if you're able to pay your creditors or lenders at the end of the day, the better for the company because it will have something to give to its investors at the end of the day. No pricing power. Yes, when it doesn't have pricing power, then there's no way it can generate enough revenue to take care of its cost and then have enough to share in terms of dividends to investors. Capital intensive and frequently need huge capex. Yes, it's capital intensive. That is spend so much in acquiring capital expenditure. At the same time, uses need so much funds to also do its day-to-day running activities in terms of working capital now. So if there's a business that tends to have intense capital, then it's not a good business. Rapid changes, if there's changes day in day out or year in year out, then that business is one needs to be very very careful about. Low and declining return on equity, low or negative free cash flow, and no or low dividend payouts. Yes, the dividend payouts can be either there might not be dividend at the end of the year, or the dividend payout is as low that it's nothing to the investors at the end of the day. So all these are quality of business from great, good, and gruesome. So it is important to know all these qualities of a business before you go on to invest your money in a particular company. So let's look at the quality of management. The quality of management is also important. Who are the people managing this business? What are their competence, their integrity and passion? How competent are they? How convinced are they, or are we that yes, they can do the job, they can turn the business around to a profit making business? Then integrity, what manner of people are they or constitute the management of the company as regards to their personality? Are they people that says okay A and they end up doing B, or are they the people that just do whatever they like because they are the ones in charge of the business, not minding that they have people they report to as investors? Also, we have passion. They must be passionate, as in they must have passion for whatever they are doing. They must have passion for whatever they are doing. So let's look at what is growth. Growth can be in the form of the following: increase in value, that is earning per share, the stock price, the earnings, revenue growth from opportunity seized, management capability, branches, staff, etc. So growth can be in the form of revenue. If maybe you revenue can grow from 10%, 15%, it is growth. Or from 15% to 20%, that is growth. Earning per share, your earning per share is the total earning of the company divided by the ordinary shares of the company. So if there's a steady growth in it at whatever rate now, it is growth. The stock price on the stock exchange, if it is moving at a steady rate, is also growth. The non-monetary growth can be branches in terms of expansion, can be in terms of number of staff. So that is also growth. Let's look at the characteristics of growth. The following characteristics are to be considered when determining the growth of a company one wants to invest in. These characteristics are consistency, sustainability, and profitability. Yes, the characteristics of a growing company has to be consistent. It has to be sustainable and it has to be profitable. Consistent in the sense that for a minimum of 5 years, it's it is growing, and then at the same time, with all resources available, that growth can be sustained, and then it is also profitable. So characteristics of growth has to be consistency, sustainability, and profitability. These characters helps you as an investor determine how long you should invest in this company or business. Yes, these characters will always help an investor to know how long you should invest in this company or business, because when you're investing, honestly, you should be investing for a long term, not short term. But now we realize that most people are doing short term as against long term. So let's look at financial statement analysis. This part seems to be a bit technical for those of us that don't have knowledge of finance, but it is mostly the science part of investing, where you need to analyze the financial reports of an organization. So you look at both the quantitative and the qualitative information within in the report. You look at the revenue growth, the earning before interest, tax, depreciation, and amortization. You look at the dividend payout, the market price per share. You also look at the earning per share, the market capitalization, dividend trend. You read the auditor's report. When you do all this, it's almost, yeah, you're good to go in investing in any stock you must have chosen or picked to invest or put your money in. Let's look at GTB as a case study. This is GTB. uh, we are analyzing for 5 years from 2016 to 2020. So it has an average growth rate of 8% on its net income. For his EBITDA, an average growth rate of 7%. For profit before tax, an average growth rate of 10%. Profit after tax, an average growth rate of 10%. And then its earning per share has an average growth rate of 11%. So when you do all this analysis and then you compare, or you do for several companies and then you compare, you should be able to know which amongst the two you or amongst the numerous companies you've selected to analyze or research on that you want to invest in. So let's look at valuation. Yes, valuation is determining the value of a company which you intend to invest in. This is mostly done by experts, which gives the company some form of credibility. Yes, so it is mostly done by experts to give the company some form of credibility. So a company can be valued on the Nigerian Stock Exchange, which is called the current market price, and then we have the intrinsic value. The intrinsic value is known as the net book value. That is when you remove all the company's liability from its assets, you should get the net book value of the company, which is the intrinsic value. So if the intrinsic value is less than the current market price, then we say the company is overvalued. That is when the intrinsic value is less than the current market price. But where the intrinsic value is greater than the current market price, then we say the company is undervalued. So, as an investor, you need to reflect on yourself. What are those things you need to look out or need to take control of or be in charge of? Your behavior, your bias, your cell triggers, your emotions, your risk tolerance. Yes, you need to look at your behavior in terms of your investments. Maybe there is a little drop in your share, the share price of the company you are investing in, you just immediately sell it off. So it's not good to do that. You need to at times hold on and then try to understand what is happening before you go ahead to sell. Then your bias, maybe you don't like a particular company, or someone working there, or being the head of the company, then being the CEO or the MD of the company, then you decide not to invest or go ahead and invest. So reflect on yourself, your investment checklist. Having an investment checklist is important as an investor. This investment list should have the following: fund, time, research on prospects, and patience. Yeah. So what to do from here? Practice what you just learned, attend another training, increase your income, invest, invest, invest. In the case where you are not, you don't understand something, or you need more clarification, you can engage an expert financial advisor to help you out. So that will be all for now. Funke? Hello, Funke?
Thank you. Can you hear me?
Yes, I can hear you.
Yeah, thank you so much for the financial enlightenment.